If you're starting to invest later in life, the worst thing you can do is repeat the mistakes I made. Because when you make these mistakes, they don't just cost you money, they cost you time. And when you're investing in your 40s or 50s, time is one of the things you don't get back. In a moment, I'll walk you through exactly what went wrong for me. But first, you need to understand why these mistakes happened in the first place. In my first video, I said something that may have sounded a little strange. I said that most people don't actually have a money problem. They have a thinking about money problem. And I know that because for years, I had exactly the same problem. When the markets would rise, I felt optimistic, so I invested more. When the market's starting to fall, I felt nervous, so I stopped investing totally. When the news sounded scary, I froze completely. Analyst paralysis, as they say. And the strange thing is, this is exactly how most people invest. The problem is, feelings are a terrible investment strategy. Most people assume that that's normal. They think investing is supposed to feel stressful, confusing, uncertain. But those feelings are often a sign that something is very wrong. Not just with the market, but with the system you're using. And it took me years to realize that. For a long time, my investing routine looked something like this. Wake up, brush my teeth, check the markets, read financial news, check my portfolio, then repeat over and over and over again. I remember sitting at work, waiting for lunch break, just so I could step outside and check my portfolio again. That routine created two constant emotions: anxiety when markets were falling and impatience when markets were rising. And both of those emotions led to a bad decision. But here's the most important part. The market wasn't the real problem. My approach to investing was. And this is where things started to get expensive. Because when you invest based on emotions, mistakes are always guaranteed. And eventually, those mistakes started piling up. Now let me tell you about my losses. At one point, my portfolio dropped nearly 30%. I felt devastated. Now you might be thinking, did the market crash? No. The market was doing exactly what markets normally do. They go up. They go down. They fluctuate. That realization forced me to look back and figure out exactly where things went wrong. When I examined it honestly, there were only a few mistakes that caused most of the damage. Here are the mistakes I made that I hope you never have to repeat. Mistake number 1, day trading. At one point, I believed I could outsmart the markets. I thought if I studied enough, watched enough charts, paid attention to enough news, I could predict what would happen next. Big mistake. Because when you try to outsmart the market, you completely get things wrong. People with better information, better technology, and far more resources know better than you. Mistake number 2. Too many stocks. At one point, I owned over 20 or 30 individual stocks. On the surface, that sounds diversified. But in reality, it turned investing into a second job. I spent most of my time watching markets that lived my life for me. And when investing takes over your life, you're making it far more complicated than it needs to be. Mistake number 3. Options trading. I bought a book, I learned the strategies, and for a short time, I thought I had it all figured out. But this is where the real losses started. Because options can magnify gains, but they also magnify losses. And when things go wrong, they go wrong very quickly. Mistake number 4 is not having enough emergency funds. I know that might sound simple, even obvious, But this single mistake triggered a chain reaction that took years to recover from. Because life doesn't ask permission before it gets expensive. I had a serious accident. I needed shoulder surgery. Medical bills started piling up. Around the same time, a tornado damaged the part of my roof. And suddenly, money I thought was invested for the future had to be used for the present. I had to sell investments. I had to go into debt. All because I had no safety buffer. And here's what that taught me. It doesn't matter how good you are at investment trading. If one unexpected event can trigger it, your emergency fund isn't just a savings account. It's the thing that protects your entire plan. After all of that, something finally changed. Not because I found a smarter strategy, but because I stopped looking for one. I realized that I didn't need complexity. I needed a simpler system, one with clear rules, one that didn't depend on how I felt, one that didn't require me to check markets every day. Specifically, I separated my money into 3 clear roles: a buffer for emergencies, a foundation for long-term growth, and a set of rules that told me exactly when to buy and when to do nothing. And once I did that, investing became something I hadn't expected. Calm. When you start investing later in life, mistakes become expensive. So the goal isn't perfection. The goal is avoiding the mistakes in the first place. Because long-term investing success rarely comes from brilliant decisions. Most of the time, it comes from not interrupting a good plan. Next time, I'll walk you through the exact system I built after these mistakes, the structure that finally brought clarity and calm to my finances. If this video was useful, please like, comment, and subscribe. Until then, I'll see you next time.